capital post our IPO in November of 2016. Let me now take you through the business performance. During the 9-month period, we registered 59% increase in the number of login files for our retail loans. On a 9-month basis, the disbursement registered a 68% growth to 24,455 crores vis-a-vis 14,592 crores during the same period of the previous financial year. The disbursement towards housing loans accounted for 67.3% and non-housing loans to 32.7%. The increase in the non-housing segment is in line with our expectations post-RERA implementation and is also in line with the industry trend. The assets under management registered a growth of 53% to 57,668 crores as on 31st December 2017 from 37,745 crores as on 31st December 2016. The loan assets are at 55,296 crores as on 31st December 2017, registering a growth of 61%. Last year, same time, the portfolio on books was 34,330 crores. Housing loans constitute 69.7% of the loan assets outstanding, and non-housing loans constitute 30.3%. In the housing loan segment, individual housing loan constitutes 57.2% and construction finance for residential units constitute 12.5% of the loan assets. In the non-housing segment, LAP or loan against property constitutes approximately 16% of the loan assets. Lease rental discounting and non-residential premises loan and corporate term loans constitute the balance. Our deposit portfolio grew by 22% to 10,668 crores as on 31st December 2017 from INR 8,762 crores as on 31st December 2016. As a part of our geographical expansion, 17 new branches were made operational during the 9-month period of the current financial year, totaling to 80 branches with presence in 44 unique cities. The company also services its customers through 34 outreach programs. The company has operationalized 3 hubs in the 9-month period, totaling to 21 underwriting hubs as on 31st December, catering to the branches and the outreach centers. During the 9-month period of the current financial year, out of the total individual housing loan disbursement, around 21% was in the less than 25 lakh segment, which can be termed as an affordable housing segment. With increase in our branch network in Tier 2 and Tier 3 cities, we look forward to increase the contribution of the said affordable segment in our individual housing loan portfolio. In terms of our gross NPA as a percentage of the loans portfolio on book, it is at 0.42% as on 31st December 2017 against 0.37% as on 31st December 2016. The net NPA stood at 0.33% of the loan assets as on 31st December 2017. Our total borrowings as on 31st December 2017 stood at 50,751 crores. The company has a diversified borrowing mix with 43% contributed by non-convertible debentures, 21% by deposits, 17% by commercial paper, and 11% by bank term loans. 5% is as refinance from the National Housing Bank and the remaining through ECBs. The capital adequacy ratio as on 31st December 2017 stood at 17.39%, of which Tier 1 capital is at 13.33% and Tier 2 capital is at 4.06%. During the quarter, we expanded our central processing center at Mumbai, giving us the flexibility to accelerate business while handling non-customer interface activities more efficiently and effectively. This also ensures load balancing of our central operations activities. We have set up one of its kind document digitization center in Noida and Bombay, which is a true amalgamation of people, processes, and technology. This is to provide ease, convenience, and comfort to our customers, as their key loan documents will now be available to them through the digital medium. With respect to the industry outlook and the ICRA report for H1 of the current financial year, it expects that the HFC industry to grow at a rate of about 20 to 23% during the current financial year, with higher contribution from non-individual housing loan segment. The individual housing loan segment is expected to grow at a rate of 19 to 21%, and non-individual housing loans to grow at about 22 to 26% in the current financial year. With this, we will now open the floor for your questions and answers. Thank you so very much.
Thank you. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset mode while asking your question. Anyone who wishes to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Kunal Shah from Edelweiss Securities. Please go ahead.
Yeah. So firstly, in terms of margins, so given that the interest rate environment has changed and we are seeing the increase in the borrowing cost, how do we see the margins behaving for us? And given that we have a relatively higher CPs as well, around about 15%, so any guidance in terms of how the overall funding cost would move up?
Well, Kunal, forward-looking guidance I can't give, but as I have also made it public many a time, I'm seeing a compression in spreads over, let's say, the midterm of 15 months, 12 to 15 months of about 10 to 12 basis points. So that is what, my gut feeling is about the entire headwind scenario on the rates of interest. And as far as CPs go, in the quarter 3, because of the volatility, we were borrowing short so that we wanted that the NCD markets or the capital markets sort of overcome the turmoil. And we will be converting, some of our short-term borrowings into long-term, very much in quarter 4.
And secondly, in terms of PMAY scheme, so how has been the disbursements and what is the how has been the overall disbursements and maybe how many is the number of loans which have got sanctioned under that?
Well, see, Kunal, as such, we do not go ahead and, source only PMAY loans. But yes, we have had our own share of success. We have till now sort of filed about 21 such requests, and we have also got a fair amount of success from the government side. So 21%, as I said, are our loans which are below 25 lakhs, and we have got a fair amount of, just a second. Till date, we have filed 13 claims for 1,361 loans, amounting to a subsidy of about 32.4 crores, and we have received subsidy on 9 claims for 530 accounts, amounting to about 12.2 crores, and the subsidy received is further credited into the individual accounts.
Okay, so total around about 1,300
Yeah.
loan accounts. Okay. And lastly, in terms of the non-individual side, particularly on the construction finance, how are we seeing the demand in most of the housing finance companies? We have seen a strong traction out there post RERA and maybe the demand from a relatively lower ticket housing developers. So how are we seeing it, and what maybe do we see that proportion inching up because of rising demand in that segment? And how would you be evaluate in terms of maybe would we want to get into that opportunity as well?
So we are very active when it comes to construction finance for residential units across all geographies. And let me demystify you. It is not that the ticket size is going to come down, because we only go with, I would say, the top developers of the country. And for this category of developers, they will generally get into large townships. We have done 2-3 of them in Q3, and these loans will hence be for a longer term rather than shorter term, because these townships take a far greater time to be completed. And across the country, there are about, if I may quote the ICRA report, because we don't get the start reports anywhere, but ICRA this time has made that about 3 million housing units, especially in 5 states, have got approved under the new RERA and the affordable housing segment. And we are active, but we will not dilute on our credit quality when it comes to choosing the developers or the projects.
Okay. Yeah. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Digant Haria from Antique Stock Broking. Please go ahead.
Yeah, so congratulations, a great quarter again.
Thank you.
Yeah, so my question is, sir, I'm seeing that last 2-3 quarters for all HFCs, including yours, the growth in construction finance has far exceeded the growth in individual home loans. So is it just a precursor that, maybe 2, 3, 4 quarters from now, once these projects get constructed, the demand for home loan will also pick up equally strong?
You're bang on right. So we have to fund the supply side in the new sort of regime of RERA and affordable housing. But if you see, the most important thing and the most significant thing is that at a portfolio level, the complexion of our portfolio mix has not changed. And as I keep saying, in large operations, give me plus minus 2%, and we will be there for products and segments. And hence, if you go at a product level, at a portfolio, then it has only gone up by 1 percentage point. Certainly, these loans in the disbursement mix will look larger because their runoffs are far faster than an individual home loan or a LAP loan. So just to give you a complexion, or a comparative, on the effective terms, individual home loans in India doesn't last more than 83 months. A LAP loan to an individual customer doesn't last more than 60 months. And a construction finance on books lasts only between 28 to 32 months. And hence, the run rate of construction finance looks far faster. But effectively at a portfolio level, the complexion of the portfolio mix does not change.
Right. Perfect, sir.
Thank you.
Yeah, and except Maharashtra, other states are also seeing, now good traction, because last time you said Maharashtra was probably the most forefront in RERA, and the other states are still
now up. Gujarat, Tamil Nadu, Madhya Pradesh, West Bengal, Rajasthan, they are the other states which have joined the, I would say, the growth momentum.
Okay, thank you, sir, and all the best.
Thank you. Have a nice day.
Thank you. The next question is from the line of Karthik Chilapa from Buena Vista Fund Management. Please go ahead.
Yeah, thank you very much for the opportunity, sir. My first question is, what will our incremental cost of borrowing be at this point?
Well, I cannot be a harbinger to that. But as I keep saying, with our product mix and with our segment mix, we are confident that between 195 to 210 basis points would be the spread. Right, at a portfolio level. We will keep on trying for that. So, the yields and the cost of borrowings actually get reflected in the spread. So, we are very confident of our sweet spot when it comes to product mix and segment mix. We'll keep doing that. And I think we have the tenacity to maintain 195 to 210 bips as the portfolio spread.
And this is against a spread which is currently at about 2.5.
That's only for the quarter. This is an annuity business, and I always say we will maintain between 200 to 210. This time I'm saying between 195 to 210.
Got it. Sir, my second question is at a processing hub level for the 21 processing hubs that you have right now, what kind of capacity utilization are they running at?
So some of them are already, so it all depends on the vintage of a hub and a branch. So new hubs will be, to begin with, will be at about 40-45% of capacity utilization. Within a year, they come to about 80-85%. And the legacy hubs or the big hubs that we have, they are doing a fantastic job, and they are doing much more efficiently. The turnarounds are faster. We have recently also launched a TQM, Total Quality Management exercise for our old and the large hubs in Noida, Bombay, next is Bangalore. So, it's a sort of a business as usual, mix and match.
And this capacity, it's measured in the form of number of applications processed per month per hub.
Yeah,
is it?
And also per FTE. We have different matrices, and every year we do publish our efficiencies per employee. So if you want to see our presentation for the investors on the web, you will see these slides.
Got it. And sir, my last question is, what would be the difference in the yield for us today for a loan which is above 30 lakhs versus below 30 lakhs?
Well, about 15 to 20 bips.
And has that changed in the last 1 year?
No, we are able to do risk-based pricing pretty effectively, even in a sector and an industry where nobody does it.
Perfect. Thank you very much, sir, and wish you all the best.
Have a nice day. Thanks a lot.
Thank you. The next question is from the line of Deepak Malik from BCCL. Please go ahead.
Yeah, thank you, sir, for the opportunity. Two questions. One, what is the difference in NPA levels between affordable housing segment and the rest of the portfolio, and how does it compare with the LAP? And second is, sorry.
See, basically, what happens is that in the housing segment, we don't do assessed income. So there is hardly any difference between, let's say, smaller loans and the larger loans, right? But yes, for products, there is a difference. And I can give you figures. I mean, if you want to say, the share of NPAs, then at an IHL, which is individual home loans, it is sitting at 0.49%. And for non-housing loan, it is sitting at 0.34%. And for individual LAP, it is sitting at 0.59%.
Okay. And the reason I asked that question was, there are lots of reports in newspapers about high delinquency levels in the affordable housing segment. So I wanted to just understand, from your perspective.
So, the beauty is that the analysts are not talking of the segment. We also do, as I said, about 21-22% below 25 lakhs, but we are not going to the unorganized or assessed income segment. So we have to paint that segment of loans below 25 lakhs with different paint brushes for the income recognition sort of distinction. So we go into the formal sector. There are formal sector individuals also who need a loan below the 25 lakhs. Everybody is not an assessed income customer.
And what would be the percentage of non-salaried customers in your product, like in your overall portfolio?
The overall portfolio, it is about 40%.
40%.
Yeah.
Thanks, sir.
Thank you.
Thank you.
Thank you. The next question is from the line of Nidhesh Jain from Investec. Please go ahead.
Good morning, sir, and thanks for the opportunity. Sir, the deposit growth has actually slowed down in this 9 months. So is it a conscious decision, or we are seeing competition increasing in deposits?
Very well said, and I must say that you would probably be the only one asking a question on deposits. So what happened was that after all, when you manage a big treasury, the cost of funds are very important. And the capital markets were trading at the lowest ebb of the rate of interest curve or the yield curve. So we knowingly priced our deposits far lower than the rest because the mix had to be corrected so that we bring down our total cost of borrowing to one of the finest levels. And having said so, twice in our journey after the BPR, way back in 2013-14 and in 16-17, deposits had gone up to about 28% of the total borrowing mix. Right away, they have come down. We have again revamped because I see that in this quarter and the next quarter at least, that far I can see, there will be a little bit of challenge in the capital market. So our deposits will once again stand strong in our total borrowing mix.
Okay. And then what would be the incremental spread on the entire book?
As I said, expect anything between 195 to about 210 basis points, pure spread.
Okay, sir. And lastly, sir, on the repossessed stock of property that we have disclosed in the annual report, if you look at the trend in last 3 years, there has been a bit of acceleration in that.
Yeah.
So if you can give any color, how is the trend in first 9 months on that?
I will. So basically, what happened was, as of 31st of March 2017, we had 274 repossessed properties worth about 170 crores. In the 9 months period, we added another 119 worth about 65 crores. And in the same period, we have also disposed of 60 worth 32 crores. And as a consequence of which, as of 31st of December 2017, we have 333 worth 203 crores. And we expect that quarter 4 will give us a lot of, with a lot of properties have been put on auction. The market is good. We have also tied up with a digital auctioning platform, and this number will significantly come down when we report the quarter 4 or the financial year results.
Just one follow-up question on this. If we would have classified these properties as NPA, will there be any impact on our PNL?
Not really, because wherever these accounts have diminuted value, that has already been provided for.
Okay, sir. Thanks a lot and best wishes for your...
Thanks a lot. Have a nice day.
Thank you. We would request participants to limit your question to 2 at a time. We'll move to the next question, which is from the line of Ronak Rajura from Asian Market Securities. Please go ahead.
Hello.
Yes, good morning.
Hi. Sir, my question is more related to the spreads. Now, you specifically say that the range of the spreads that you're likely to maintain is between 1.95% to 2.10%. Now, my question is, if I just do simple arithmetic, all the housing loans are priced at about 8.5% to 9%, whereas the non-housing loan book would be of a higher yield. And housing constituting about 60%, individual housing constituting about roughly 60% of our portfolio. So the weighted average yield would effectively keep on tilting downwards.
Yeah.
In such a scenario, how do we still maintain the spread ranges in this? Because if you see the housing loans are priced way below our current average yields of 10.12%.
See, we have the freedom to reprice our portfolio. 73% of our portfolio is on variable interest rate. And we have 5 reference rates in our system, which are product and segment related. So we have that freedom. Already 3 banks have upped their reference rates or MCLRs by 5 basis points.
Right.
So why do you forget that even a loan can be repriced upwards?
Correct.
Every time a loan will not be repriced downwards.
Right. Okay. And we are saying 73% of our book is on the variable.
Yeah, and even the fixed rate book doesn't have a pure fix. So they have a 3-year fix, a 5-year fix, and they come to a variable. So, I'm very confident that we can maintain that sort of a spread going forward.
Okay. And sir, one more thing is on the asset quality. I mean, one thing which PNB Housing should be really given accolades about is their asset quality in spite of reasonably high proportion of the non-housing segment. Now, what could be the secret, sir? I mean, do you do something which is very different from the market? Because generally the LAP portfolios or the non-housing segment is supposed to have higher delinquencies across the industry. PNB seems to be an exception on this front. So what is it that you're doing so different from the market?
It is our robustness and our head on our shoulders. That's about it.
Okay. So nothing in terms of differentiating process or, I mean, I understand.
We are working in the same country with the same citizenry, in the same denomination of the currency. It's all about conservatism. It is all about, the wisdom getting translated and transmitted to our hubs and our sourcing channels. And, we don't like to say no, but we know how to say no.
So then what percentage of our loans would be actually rejected?
About 22% at a gross level.
22% of the loans are rejected. Okay.
Yeah.
Okay.
For a variety of reasons.
Okay. And any specific segment or geography that you see the gross NPA is really rising? Like there have been, it is just answered. So the affordable housing segment, which is the low ticket segment, is seeing a little higher delinquency. Not that we have, our average ticket sizes are way above that, but do you see any sense of the general NPA rising in the industry? I mean, and any specific segment that you feel is prone to more delinquencies?
See, let me tell you, this business is not about fill it, shut it, and forget it. The back end rigor has to be maintained continuously. And that is why this year we have created a load balancing and a DR side of our CPC and COPS. And we have actually applied technology to bring in far greater efficiencies in our banking and security management. And these are the tangible differentiators between PNB Housing and the rest. We invest a lot in surveillance, in monitoring, and in operational rigor. As such, when we come down to geographical, I would say, distinction in portfolio behavior, we are not seeing segment-wise or geography-wise any difference. But I am an avid reader also, and what the analysts have been saying, the credit analysts, that Delhi NCR and Tamil Nadu are showing some sort of higher increase rate in the NPA figure. But as of now, not on our portfolio.
That will be it, sir.
Yeah.
Thank you.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all participants, we would request you to limit your question to 2 at a time. Thank you. We'll move to our next question, which is from the line of Bobby Jairam from Falcon Investments. Please go ahead.
Hey, good morning.
Good morning, Bobby.
Good morning. Your leverage levels are lower than your competitors. What is your target for this?
Well, see, the leverage levels are lower than our past because of a huge $500 million worth of IPO, which happened 14 months back. And we keep on telling the markets our business as usual leverage levels will be around 10 times, and between 11 to 12 times we would be going into the capital markets to raise tier 1 equity.
Right. So around an ROE of 15-16%, around that level as well.
Well, if you see, our OPEX is coming down, our CIR is coming down, we expect our return on assets to be better. And if we are leveraged at about 10 times, then I think we should be a shade better than what you are projecting.
All right. The other question is, your brand is mainly known in the north. So how are you able to penetrate the other regions, east and south and all that?
No, it is not an Indo-Gangetic brand. It's a pan-India brand. And if you go and see our investors' presentation on our webpage, our portfolio is very well distributed between north, west, and south. They're almost equally distributed. So we don't have to do much different or go-to-market strategies for different zones.
Right. All right. Thank you.
Thank you. Have a nice day, sir.
Thank you. The next question is from the line of Bhaskar Basu from Jefferies. Please go ahead.
Yeah, a couple of questions. Firstly, in terms of your loan mix, we've seen a gradual shift from individual housing towards non-housing. Is there a target mix which you have in mind over the next 1 to 2 years?
As I keep saying, it will be plus minus 2%. So you see, we have about 8 quarters presentations on the web page. It is getting very well maintained. And this quarter also, it has only moved by 1 percentage point. So just to give you a little bit of flavor, total housing, which includes construction finance, will be between 70 to 72%. Right? LAP and non-housing will be in the vicinity of about 18 to 20%, and the remainder will be between LRD and CTLs. Plus minus 1 or 2%, because large operations, going forward, it will remain constant.
Okay, because we've seen quite a few lumpy LRD deals, I think, over the last few quarters. And
1 quarter.
Yeah, even last quarter, I think we had.
Yeah, and that is why LRD has jumped. But the total composition of non-home loan has not jumped more than that. LRD per se has, because we did 2 large LRDs.
Right. And in the context of rising bond yields, what is the target borrowing mix which you'd like to maintain? We've seen CPs going up this quarter, NCDs going down, bank loans going up. So what is the mix which you would like to maintain?
So primarily what we will say is that our deposits will be at about 25%. Our NCDs will remain at about 45%. So that will constitute about 30%. And bank borrowings, because now banks are allowed to do non-MCLR loans to corporates, so related to or linked to T-bills or LIBORs, which are known as FCTL, will probably go up. NHB refinance will remain same. ECB will keep on coming down because the repayments have started.
Okay. And
CPs will remain between 15 to 18%.
15 to 18%. Okay.
Yeah.
And in terms of incremental yield, what is the kind of incremental yield you're seeing on your construction finance or non-housing portfolio?
Well, the yields, if the markets move up, the yields will move up. Otherwise, and the markets will move up, cost of funds keep on moving up. So it's a dynamic sort of a situation. And as I keep saying, as a business manager, my first, I would say, objective will be to secure or protect the spread between 195 to 210 bps. And that's how we are going to price our incremental growth and our products.
But in the context of rising competition, don't you think that your ability...
How long? What sort of liquidity are they sitting on? It will get absorbed.
Okay. And my final question is, what proportion of your loan growth is coming from balance transfers?
Well, we have no strategy on balance transfer. We never have a sales strategy or acquisition strategy which says balance transfer, no fees, lowest rate. You can check it out. But so it is 4-5% on the portfolio.
Of the portfolio, about 4 to 5% is coming from balance transfer.
And that is voluntary balance transfer because of better service, better rate, and a better brand. But we have not gone ahead and ever sort of, had a tactical move to do balance transfer, even in quarter four when the others are busy doing this.
Okay. Just one more final question. We've seen increase in ad spends of late. Is there, what's the strategy there, and do we see an increase in cost going forward?
You like the advertisements?
Yeah, when we've seen...
They are decluttering the crowded market. Yes, it is strategic for brand recall, quarter four and quarter one.
At a time when you're actually already growing at about over 50%.
Yeah, but we can't take the markets for granted.
And does it mean that your OPEX to AUM...
That's a good observation. So basically, there are two components to our OPEX, especially in this quarter. One is that all our incremental facilities will be up and running. So as I said in the beginning of the year, we started the year with floor space of 210,000 square feet of usable office area. We are going to add 115,000 square feet more to it. It is been already leased out. It will be put to economic use by, let's say, a month or so. People have been hired, and yes, this ad campaign is also happening. So 2-3 basis points of OPEX to ATR is a no-brainer increase in quarter four. But during the year, the full year as we take, we will be very much far lower than last year or the previous year.
And over the next 2 years, you had a target of bringing it down.
I have that target still.
You still stick with it?
Yeah.
Okay. Thanks. That's all from my side.
Thank you.
Thank you. The next question is from the line of Nischint Chawathe from Kotak Securities. Please go ahead.
Yeah, hi.
Hello.
Good morning and congrats for a great set of numbers.
Thank you, Nischint.
So do you maintain a breakup of disbursements between disbursements for new loans, balance transfer? I think you mentioned that it's around 5 to 6%.
At a portfolio level, I don't do it at an incremental level.
And on
because we don't have a strategy of balance transfer.
No. I was just curious if you have any breakup either on outstanding or incremental on new houses, used properties, and balance transfers.
No, I don't have any such data.
Sure. The other question was, I think if I look at the shareholding pattern today, promoters level has kind of come down. So we are just curious as to when you have the next level of capital issuance. Do you have any indication from the promoters whether they would participate or not? And in that scenario, if the shareholding falls below a particular threshold level, how would the rating agencies react to that?
Well, as of now, I have got no guidance from my shareholders because the next round of capital raise, I don't think is going to happen before 18 to 20 months from now.
Sure. Just one last question. Your coverage ratio has gone up this quarter. So how should we read that? Is it something which is to do with the aging of NPLs, or how should we really think about it?
No, it's a conservative approach and also the seasoning of the buckets. Plus, if you add the contingency reserve, then our PQR is very smart, which once again confirms that this management believes in conservatism rather than just showing growth in profit quarter on quarter.
Sure. And just one last point, if I can squeeze. In the affordable housing segment, what would be the breakup between salaried and non-salaried segment?
It will remain the same, Nischint. As I said, we are not gunning towards a market share or a particular segment. We are doing a business which we think we can acquire, process, underwrite, deliver, and service. Right?
Okay.
So particularly, when it comes to, let's say, what are you gunning for? I'm not gunning for any damn thing. Whatever is the opportunity, I will certainly utilize it to my benefit.
Okay, sir. Thank you very much and all the best.
Thanks a lot. Happy day.
Thank you. The next question is from the line of Abhishek Murarka from India Infoline. Please go ahead.
Hello, sir. Good morning and congratulations on a good set of numbers. So my question is, you said that there will be an opportunity to increase yields to protect spreads.
Yeah.
Now, a lot of it would also be determined by how competition is reacting and how the larger HFCs are able to, whether they are increasing their yields or not. So in that scenario, your yields, ability to increase yields is not really going to be independent. It's going to be dependent on the market. So do you see that as an impediment to maintaining this 195 to 210 basis points spread that you're, targeting?
Well, what you are saying is absolutely correct and obvious. But the thing is that we will not like to be irrational when it comes to our profits. So we do distinguish between profit and profiteering. And I'm very sure my august colleagues in the industry will also have the same sort of point of view. And how long, and I keep saying that, will they do irrational pricing? Okay, I can understand Q4. But come Q1 of the next financial year, everybody is going to look at their profitability.
Sure.
Yeah, and the cost of funds in the industry are fungible and common sources. So it's not alone that for PNB Housing, the cost of funds are going up or the liquidity is becoming a constraint. It's for everyone.
So
when it comes to banks, because the second question will be on bank cost of funds, well, then the OPEX is 4.5%. So are people making profits is a very big question.
Right. And so in that context, then, in your borrowing mix, the proportion of CP is higher than generally what is observed with other housing finance companies. So is there any particular reason, or it's not even transient, right? You said it will remain between 15 to 18%. So it's not really a transient factor.
No. So what I would say is please compare us with the big housing finance companies and not small housing finance companies. And all of them, and look at the average outstanding rather than the reporting date outstanding. That we can also do.
So on an average, your levels would still be at 16-17%, or would they be lower?
Yeah, this particular quarter, we knowingly went slow on long term. A, because we are planning a huge masala bond of $500 million, where IFC Washington DC is already an anchor. We have signed an MOU with them. So we know that our short-term borrowings are going to get replaced in the recent future. And the market was doing so much of yo-yo that we said, let us settle down, and then we will go to the bond market.
So has it settled down, as in your view?
I think, yeah, we are almost, I think by Q4 we will go to the masala bond market, and we will have a better term management. It is a conscious sort of a call because we knew this is in the offing.
Yeah. So actually, no, I'm sorry to, keep on this point, but it's just that if you see that the markets are settling down and you are going to replace your CPs, then why is it that it's still going to be in the 15 to 18% range and not lower?
Because my portfolio is also going to grow.
I'm sorry?
Because my portfolio is also going to grow. And what is the harm in having a 15% CP? There's no prescription.
Right. No, it's just a little different than the mix that I'm...
Our treasury is huge. We manage our fund flows beautifully. Our cash management is backed up with 17 bank lines for overdraft facility.
Sure.
It's not that we are going uncovered on CPs.
Yeah, of course. What
is the, I would say, the anxiety all about if we can manage it?
Sure.
Manage it well.
And sir, the other question is on the costs. So just a question on the commissions and brokerage that you would be paying out to DSAs. Generally in the industry and for yourself, have you seen that increase in the last, let's say a few quarters, especially as growth rates, are high for several large companies?
No, and we have not seen it over the last 4 years. And we even in Q4, let me set your anxiety to rest. We are going to have no incentives and bonuses and all those things for the third-party vendors.
Okay. Roughly, as a percentage of disbursements, how much would that be?
Is about 0.8%.
Okay. Okay, sir. Thanks and all the best for the
Thank
next
you.
quarter.
Thank you. The next question is from the line of Rakesh Jain from Jasper Capital. Please go ahead.
Hi, sir. Just a small question. As you mentioned that you had a fundraising and there's a regulation of non-MCLR loans to the corporates. So how does it benefit? Means how does it work?
What did you say? Can you repeat your question, please?
There's a non-MCLR loans to the corporate. There's some regulation regarding that.
Non-MCLR loans to corporate
Yeah, that's
banks.
from the banks that we have got these limits.
Okay. So does it help you in getting a lower cost of
Yeah,
funds?
they come at a very reasonable cost.
What would that be?
It is in the range of about 740 to 760 bips.
Okay. And what would be your the subsidy in the PMAY scheme for the quarter? Any?
No, it's not a subsidy to me. It's a subsidy to the end user.
Yeah, so what is the amount for that?
Yeah, so till now we have got 12.2 crores worth of subsidy from the government for 530 accounts.
Okay. Thanks a lot.
Thank you.
Thank you. The next question is from the line of CG Philip from Axis Securities. Please go ahead.
Yeah, good morning, sir. I just had one question. Are we looking to expand our average ticket size, say at what the level that we have?
No. So as I keep saying, my segments, my product mix and my go-to-market strategy is going to be same, and we are not looking at large ticket sizes. Even if you would have seen our presentation, in the non-housing loan, the ticket size has gone up a little because of the two big LRDs that we have booked in quarter 3, not because of individual average ticket sizes.
Okay. Thank you, sir.
Thank you.
Thank you. The next question is from the line of Sangam Iyer from Shubhkam Ventures. Please go ahead.
Yeah, hi. Congratulations, sir, on impeccable execution on both in the.
Can you please speak a little ascender and closer to your microphone, please?
Am I audible, sir?
Yeah.
Yeah, sir, congratulations on a great set of numbers.
Thank you.
So just want to understand, given the headwinds that were there this financial year, we still managed to come out with great loan book growth and excellent execution in terms of profitability, etc. So now going forward for the next financial year, when things are more or less in our favor in terms of all the headwinds behind us, etc., how should one be looking at the overall industry growth as well as the growth for PNB Housing here?
Well, industry growth, I don't think will be more than about 16 to 18% at a portfolio level. And as I keep saying, because we have an expansion-led growth strategy, we will be at about industry average into 1.5 to 1.7 times.
So even during the testing times, we did much better than that. So if things are much better in terms of the overall environment, do we see that there could be a further acceleration in the growth coming in, or do we see in terms of growth we would be content to give this the number and then execute a much better numbers going forward?
So I am like a doctor and a farmer. I'm positive, I'm realistic, but I would not count my chicken before they're hatched.
Okay. Great, sir. All the best, sir.
Thank you.
Thank you. The next question is from the line of Naveen Bhotra from ARC Finance Limited. Please go ahead.
Congratulations, sir, for the
Thank you, sir.
Excellent performance once again. My question is regarding the total market size of the mortgage opportunity in India is roughly around 17 lakh crores per annum. And
that is outstanding portfolio, sir.
Yes.
Incremental is about 4 lakh crores a year.
Yeah. So banks and NBFC share is equally shared 50-50 right now. And
no, so banks are 62 and HFCs are 38.
Because in the next slide we have seen that as on 30 September, 8.5 lakh crore is the total share of the housing finance companies. And out of that, we are having 6%.
I will just make you understand that $15.5 trillion is actually housing portfolio. It's not total portfolio.
Okay. So my question is regarding the how do you see this share of 60-40 in favor of banks and NBFCs going forward?
I think it is going to remain constant. The housing finance companies will grow faster. So their share in the outstanding portfolio might go up by 1% or 2%. That's all.
Percent and 2. And out of that, if the overall market for NBFCs are going to grow 1 and 2%, our share in that, how do you visualize it going 4 to 5 years down the line?
No, sir. The market is not going to grow by 1 or 2%. I say the competition between banks and HFCs might see a 1 or 2 percentage point difference. That's all that I said.
Okay, sir. Thank you.
Thank you.
Thank you.
Thank you. The next question is from the line of Omkar Kulkarni. He's an individual investor. Please go ahead.
Yeah, hello, sir.
Good morning.
Good morning. Congrats on a good set of results once again.
Thank you, sir.
Yeah, my question was regarding where do you see your ROE and ROA from couple of years from now?
In couple of years, my ROA should be like an industry, I would say the big four above us, something like 1.7 to about 1.85%. And if I lever myself 10, 11 times, that's going to give you the ROE.
Okay, and what about the ROE?
You multiply ROA by the lever, you'll get the ROE.
Okay.
Any other question, Mr. Kulkarni?
No.
Thank you. We'll move to the next question, which is a follow-up from the line of Deepak Malik from BCCL. Please go ahead.
Yes, sir. I have a question on your contingencies and NPAs. If I'm reading it right, your AUM is about 57,000 crores outstanding, and gross NPA is about 0.42%, which is about 230 crores, and the provisions are already for standard assets about 279 crores.
Yes.
Does it mean that whole of gross NPA is kind of fully provided for? Is that the right way to read it?
No. See, now what happens is that standard asset provisioning is a sort of a provision that you carry on your balance sheet when the account is current. That means when it is paying on time. Because there is a probable risk of that percentage, and these, standard asset provisioning is linked to loan amounts, the product, loan amounts and LTVs by the regulator. Then comes NPA. So when an account comes into an NPA bucket, the standard asset provisioning moves out and you have to do seasoning of the buckets and then provide as per the regulatory requirements. This contingency reserve that we have already done of about 75 crores today is a reserve against accounts which are current today but have given us some sort of grief or in the past. So as a conservative set of management executives, we carry additional provisions that in case these accounts again come into delinquency of any category, we have enough and plenty of reserve not to disturb our profitability. That's all.
So in a way, the provisions are, let's say, this 279 crores plus this 75 crores or 79
76 crores, yes.
To take care of any exigency, whether it is the actual net NPA not getting paid off or whether it is a new potential NPA.
Yeah, potential forward flow or something like that. Because see, we have to, this, as I keep saying, this is annuity business. And you have to keep the operational rigor on and your balance sheet management on. It's not fill it, shut it and forget it. So we create these sort of reserves against accounts for a rainy day. That's all.
Right.
And full tax is paid on this.
Correct. So just to simplify the math, basically, the gross NPA is about 220 crores, net NPA is about 150, 160 crores, and the standard asset provisioning is 279 plus another 79 for exigencies, just in a layman's terms, not getting bound by what are here.
Yeah, standard asset is for the accounts which are running all right.
Correct.
Right?
Correct. Thank you.
Thank you. The next question is from the line of Bhaskar Basu from Jefferies. Please go ahead.
Hi, sir. This is Harshit from Jefferies.
Hi.
Hi. So just one question. So if I look at our net interest margin sequentially, that has gone down around 15 basis points.
NIM has gone down
by around 10 to 15 basis points
Yes,
sequentially.
it has.
Yeah,
It has.
and correspondingly, our spreads have been maintained, our cost of funds have
Correct.
reduced, mix
Correct.
has shifted towards non-housing, which is relatively higher yielding. So overall, how do we see this? Because and leverage is also actually reduced.
Yeah. So what I will say is, leave alone on the mix, portfolio mix that I keep saying 1 or 2 percentage points here or there, the portfolio is going to remain the same.
Okay.
Now the NIM has got compressed because we were carrying large amount of investments, average for the quarter, and we diluted those investments on the last day for cash management purposes, and we did not take an overdraft that day. So that is why our NIM got compressed, though our spread had widened.
Okay.
So I mean, yes, I mean, if we would have, that's again, we were thinking that there would be a sort of a liquidity crunch.
Okay, and
because the quarter 3 tax payments were due, so we carried excess of liquidity. Generally, we carry 15 to 20 days liquidity. We carried much larger.
Okay, so that was a one-off, but as we go forward, then and as leverage improves, you see this trend again reversing, so NIMs being higher than what it was?
I see if the spreads, and I have sort of, committed myself that if the spreads come down, and that's the first component of NIM.
Right.
To about 195 to 210 from today's 234.
Right.
Then for NIM to go above 310 would be a challenge.
Okay.
Because if you were to take total cost of funds to total interest income, that will go up as the lever goes up.
No, I'm spread parts I understand, but only on the basis of leverage, we expect leverage to increase in the medium term.
Yeah, so if you were to take what percentage of your interest income got eaten up by interest cost, if the lever goes up, that ratio will enhance. Today it is at about 68%, if I remember correctly. Right, so that will go up when the lever goes up.
So NIM should actually fall slightly if the leverage is going up.
The NIM can fall a little bit, but then don't forget that the other incomes and fee income and non-fund-based incomes are not included in NIM.
Will that be very high for us?
Yeah, so if you were to take the gross NIM, that is NII plus fees minus cost of acquisition, then it is about 356.
356. So you are basing around 40 to 50 basis points is from other than...
because we have a huge amount of securitization portfolio.
Okay.
And that is why portfolio on books and AUM has about 3,000 crores difference.
Okay.
And we get a servicing fee of it.
That is a major
in the first 9 months, we got a fee of about 189 crores of servicing fees alone.
Okay.
Yeah.
Okay,
You're making me revise like as if it was my senior Cambridge exam.
Okay, sir.
Yeah, it was 187.15 out of a total fee income of 291.
Okay. Okay, sir. That was helpful. Thank you.
Thank you. Ladies and gentlemen, that was the last question. I would now like to hand the conference over to Ms. Deepika Gupta-Padhi for closing comments.
Thank you everyone for joining us on the call. If you have any questions unanswered, please feel free to get in touch with Investor Relations. The transcript of this call will be uploaded on our website, that is